Good morning, all. Steve Parisi here with IBC Global. Hope your day's off to a fantastic start. We've got Scott Witt, actuary at Witt Actuarial Services. How you doing today, Scott?
I'm doing just fine. How about you, Steve?
Great. It is springtime over here, nice and warm. Had a nice run this morning. I'm loving it.
It's about time.
Right on, right on. Well, we've got a great topic today that there's been a lot of noise around, a lot of interest from consumers kind of on the fence saying, should I get into a policy now? Should I wait with the new 7702 update? And what's going to happen to the guaranteed rates on whole life insurance products? And what I wanted to talk to you about, because you're an expert in this field and you've provided some great information to me, is really just drawing a distinction, call it, between the guaranteed rates on a whole life insurance product and then the guaranteed values and how's it work, what's it look like, and from a consumer standpoint, does it really make a huge difference where I have to get in right now, or can I take my time in a sense? You know what I mean?
Yeah, I think this is very timely, and there is tons of confusion around this topic, and understandably so. It's a very confusing topic, and even before this update, in my experience, it was more commonly misunderstood than it was understood. So in a sense, this update has a chance for us to set a lot of people straight who had misconceptions all along. And I think maybe before we get into the weeds a little bit here, it's important just to recognize that this is really good news for the industry, and it's really good news for consumers. And I think that some of what's getting lost in the shuffle here is consumers and some commentators see that some of the key rates are dropping from, let's say, 4% to 2%, and they feel like that's a bad thing. But as we get deeper into the podcast here, we'll explain why that isn't the case. But at a high level, I think it's important to understand that these changes allow life insurance companies to keep doing what they're doing and able to offer these products. They were starting to get squeezed between different limits, and some were approaching a point where you'd have to decide whether or not you could even continue to offer whole life, or you'd have to switch to universal life. These changes now completely open up the doors for whole life to continue as it has been. But most interestingly, and especially for a lot of the clients that you and I deal with, it has now become substantially more appealing to buy an accumulation-oriented policy. You are able to now stuff more money into the policy for a given level of death benefit than you could prior to the change. And I know a design that comes up frequently in both your practice and my practice is that clients are basically buying life insurance as an investment. If you're selling insurance, you can't talk about it like that, but you and I both know that a lot of wealthy people are treating life insurance as a tax haven, and the life insurance is just an ancillary benefit. The death benefit component of that is just an ancillary benefit. And so their objective is to minimize the death benefit as much as they possibly can. These changes that just came into place and will be gradually adopted in the coming year, let's say, those changes allow for substantially more efficient accumulation. You can, if you're stuffing in, let's say, $100,000 of premium, you don't have to buy nearly as much death benefit as you used to. That means your future mortality charges will be lower and your internal rate of return will be higher because the policy is more efficient. There's less drag. And so that's excellent news for people that are interested in those types of policies.
Yeah, no, I appreciate you kind of setting the ground straight there, because with all the information out there, I think it's what it is there is a marketing aspect to anyone's business. But when anyone tries to market something without having the information yet and misspeaks, some people will hear that and run with it. So, for example, what I've seen very, very often, especially over the past month or two, is, hey, with whole life insurance products, the guaranteed rate is going down. And that could fall anywhere with whole life insurance products. I've seen them state a range between 2 to 3.75%, depending on the carrier and what and how they set it. But as a consumer, like if I hear that, my mindset would be, all right, if there's a guaranteed rate of 4% now, and then it's going to be 2%, say it's with the same company, that means I'm going to have significantly less value if I get into that product, or whole life won't be what it used to be because the guaranteed rate is going down. But there's more elements to it, and I know we don't have to get into the weeds here, but you know it. I mean, you can slice it apart as far as you've got the guaranteed rate, but then you've got the insurance expenses and other areas. My big thing, and I'll talk about this often, is you've got the guaranteed rate. And even with the present dividend rate on a product, that's always a gross rate. How I'll explain it, that's credited after the company's mortality charges, insurance expenses. I like looking at the net IRR, and I know you've got other formulas to calculate it as well, but what's the net return on cash value over time? So I guess we can kind of speak a little bit to that. Does a guaranteed rate decrease automatically mean that the guaranteed cash values will be lower no matter what?
Yeah, that's a great question, and I think maybe just an example that's removed a little bit from the world of insurance, and let's just bring it into finance. And let's say that I had to pay you $1,000 a year from now, but I wanted to set aside the appropriate money right now to make sure that I could fund that liability. And there's two different scenarios we could consider. One scenario, I earn a 10% rate of return on the money I set aside now. And the other scenario, I earn a 5% rate of return. And what I'm trying to build up here is this is analogous to what an insurance company is using in its determination of guaranteed cash values, and then also the reserves that they hold behind the scenes. And if I had a 10% interest rate, I would have to have $909 set aside right now. If that grew at 10%, I would have exactly $1,000 to pay you at the end of the year. All right. So the 10% rate has an amount of $909 associated with it today. If I did a 5% interest rate, I would have to set aside $952 today. So by moving from a 10% assumption to a 5% assumption, I actually had to increase the amount that I'm holding today. I had to increase it from $909, or what did I say, $1,000? I had to increase it from $909 to $952. But the way that people are interpreting this interest rate change is when they see the drop from 4 to 2, let's say, they think that they are getting lower guaranteed cash values. In actuality, if you held everything else constant, that drop from 4% to 2%, if indeed that's what the insurance company chooses to do with its guaranteed cash values, it would actually boost their guaranteed cash values, because life insurance cash values for whole life insurance are calculated on a prospective basis, present value of future benefits, less present value of future premiums. And so you're looking forward, and the rate of return that's assumed going forward is key in determining what those cash values are today. I think it's also important to understand that the nature of whole life insurance is that there is a forced endowment, if you will, at the age of maturity. It used to be age 100 when the 1980 CSO was the governing table for mortality. When that got updated to the 2001 CSO and was updated later in the 2000s when it was actually implemented, the age of maturity changed to 121. So when you look at most policies today that are being issued and illustrated, you will see that at least the base portion, I know it can get confusing with the different types of coverage on a whole life policy, but at least with the base portion, you will see at the age of maturity that the cash value grows to equal the death benefit at that age. And so that's really just proving the point that it's this prospective formula. And when you get to the end of it, by definition, the cash value and the death benefit have to equal each other. So I'm sure that's probably mind blowing for people who had convinced themselves that this drop in the rate that's used to determine the guaranteed cash value was somehow a sinister thing, and policyholders, were getting the short end of the stick. That's not the case. This is not a universal life guaranteed rate. That is much more straightforward. Where if the interest rate on that drops from 4 to 2, that is bad news for the consumer. There's less of a guaranteed component there. So I know that was quite a mouthful there, but I mean, I don't know if we want to drill down a little bit more just to flesh that out.
No, that was great. And I mean, what kind of popped in my mind there too, and this just comes from a conversation I had with someone else this morning, is if I'm a consumer or if someone's listening to this saying, okay, like a lot of that is, sounds interesting, but I just want to make sure I get the best policy. I'm looking at whole life, IUL, talking to different people. That is like what your specialty, your expertise is, and looking at their portfolio. Like that's extremely valuable. And I've heard people express this to me that have worked with you, whether they bought a policy through us or someone else, was, hey, like he's a complete fiduciary talking about you, saying, here's what to do. Here's the recommendation. You know how to dissect the whole life insurance product without selling it. Like you make no product sales, it's just pure recommendations. So you can have someone that can help in that respect to really make sure you, being the consumer, are in the best possible position without getting biased information, from anyone. I mean, even from my position, you and I have spoken, the carriers I prefer, how I like to design products to maximize value. But still, when you work with someone, you're looking out for them. And I've seen that constantly. So didn't mean to just throw a random promotion in there. But I think if I'm a consumer, like what you just said there would give me peace of mind to know, okay, I may not get that stuff, but this guy does, and I can just focus on my business and moving forward, and he'll take care of it for me.
I welcome all types of promotion, random or otherwise. So thank you. I do think that, that gives us a little chance just for maybe a little bit of a history lesson. And I know I'm preaching to the choir here, but for your listeners, prior to the mid 80s, life insurance was pretty much the wild, wild west when it came to taxation. The death benefits were not taxed, and there really wasn't any consideration given to taxation of the gains within a policy. But with the emergence of really high interest rates in the late 70s and the early 80s, life insurance suddenly became a hot savings vehicle. And so in 1984, some definitions of life insurance were adopted into the tax code. And while it's a little bit in the weeds, I think it's important for the listeners to understand just how complicated this is behind the scenes, and how understanding these, and while the client may not have to understand them, it's important that their advisor does. And back in 1984, then, there were two different definitions of life insurance that were developed. One is known as the cash value accumulation test, and that's basically what all whole life insurance policies use, is the cash value accumulation test. And then separately, there was a guideline premium corridor test, and universal life policies really have the choice of which of those tests. Are they going to use what's known as the CVAT, the cash value accumulation test, or are they going to use the guideline premium / corridor test? And so until recently, that was quite critical. Let's say if you're looking at a universal life policy, to know which definition of life insurance best fit your goals. The reason that everybody's talking about these changes, and the reason these changes were necessary, is that the interest rates that were coded into that tax act that was passed in 1984, they were hard coded as a fixed interest rate. And those interest rates may have been appropriate at that time, but as interest rates have continued to go down, 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 and have approached zero, that's what needed to be changed in those rules. So within the definition of life insurance, that original law that was passed in 1984, we now have different interest rates that are in those rules. And again, the original motivation of those rules was to make sure that a product was not being overly abusive and was more of an investment than it was an insurance product. Those rules now have in essence been loosened a little bit so that products can be more investment heavy in terms of the cash to death benefit relationship. They can be more cash heavy now than they could from the period of 1984 up until the end of 2000.
Mm-hmm. Yeah, no, really appreciate that. I guess what we can do to kind of close the loop on the guaranteed discussion, there's one example I want to reference that kind of sort of just gives a picture of what whole life might look like because it is a different product, and then get into the overall point, which I know you've expressed several times based off of actual data and proof, is bridging into the non-guaranteed values and the importance, the reality of it when you really look at things. But as far as this change, I mean, the thing is right now, when it comes to retail whole life insurance products, companies haven't updated yet. There's no products available from a carrier as of today, March 12th, when we are shooting this podcast. With that said, my company, we've got experience in bank-owned life insurance. We're working with a bank right now, and one company has updated their BOLI product, and where I had the most fun with it was looking at the old product compared to the new product, generic illustrations and then the actual case. And my intent here is this might kind of help consumers look at it and say, okay, with a guaranteed rate compared to the guaranteed values, there's not much of a real difference. High level, the guaranteed rate on the new BOLI product with this company, one of the major mutuals, dropped by 50 basis points. So the guaranteed rate dropped by 0.5%. Yet when you look at the guaranteed cash values, especially over time, they were greater in the new product, which for a consumer, you hear lower rate, more value, like, okay, what the heck? And that goes back into what you mentioned as far as there's so many other components that have an impact on that guaranteed value. Now, the trade-off for the consumer, the bank in this case, is the death benefit initially was significantly lesser. Closed a little bit, not quite 50%, but it was less. So greater cash value, but lesser death benefit based on the same deposit by that bank with that particular product. So, it gives some insight just as far as the guaranteed rates and values. Granted, BOLI is a different product than whole life when you really look at it. But it is interesting to me because people see that and just kind of say, all right, that's completely different from what I've thought. And that begins to shed a little bit of transparency. And that was with the guarantees. And then we can kind of bridge into the non-guarantees here. It was the exact same thing, actually to a greater extent with the non-guarantees when you looked at it. Lower non-guaranteed rate, but stronger non-guaranteed net value. So a net internal rate of return was stronger with a new product, even though the gross rates were less. If that makes sense.
I think that's a great example of how these changes actually benefited the people that were in that space. And so at first blush, it sounds like bad news to have the rate that's used in the determination of the guaranteed cash values to have that drop. It actually, in the situation you just outlined, it sounds like it led to both higher guarantees and higher non-guarantees.
Yeah, 100% on the cash value. The death benefit with the old product was stronger for a solid 20 to 25 years. Over time, the new product did overtake it, though, on the guaranteed and non-guaranteed death benefit over a long period of time. And with the case studies we've looked at, it depends on age and gender. When you look at how BOLI products work, what's the group that they're actually putting the insurance on. But the main point is both the cash value and death benefit long-term were stronger. The cash value, immediately we see either stronger or very, very consistent with the old and new, but the old one does have a higher death benefit initially.
Sure. Well, that I jotted down a number of things, just some quick points that I want to touch on here. What you just described reminded me that it's important for us to recognize and for the listeners to understand that you've got policies that are on the accumulation end of the spectrum, and you've got policies that are on the protection end of the spectrum. And much of my focus and my comments today have been targeted at folks who are on the accumulation end of the spectrum. But certainly you've got people out there that are buying life insurance for the death benefit, and maybe they're seeking a level death benefit, and they're wondering, how these changes affect them as well. So I think it's important to recognize that there is a difference between those two. Another point that I wanted to make, going back to some of the history. After the definition of life insurance rules came out in the mid '80s, a few years later, that there was still it felt there was still a need to further define what the maximum amount of money you could put into a contract would be, and so these modified endowment contract rules were adopted. A lot of people allude to that as a 7-pay test, and so I think it was '88 when that was passed. And those rules exist today. They also were hard coded, and those rules were also updated as part of this change. So very significantly for the accumulation oriented policies, you now can put more money into a policy without it being designated as a modified endowment contract. And for the folks that are buying accumulation oriented policies, they usually want to avoid MEC status, because once your policy is designated a MEC, any distributions from that policy forfeit the tax advantage that they otherwise would have had. Those policies are now taxed on a gain first basis, and there's a penalty tax on any gains for distributions prior to age 59 and a half. So it's also important to recognize that not only was the definition of life insurance updated, but the MEC rules were updated, and so you were able to stuff more money into a policy without your contract being targeted as a MEC. So I've got a couple other points I want to make, but I just don't want to ramble on here. I'll kind of wait to try to inject them before we wrap up.
Gotcha. No, appreciate that as well. I mean, it's interesting always on the MEC test. I mean, I like digging into that, but that's a good topic for another time. Keep going with your points. I mean, I wanted to bridge into the non-guarantees as well, because I know we've been focused on the guarantees because that's the hot topic, but it's good to understand the non-guarantees because they are important. But keep hitting on your points. I don't want to completely detract.
I really just have one more before we segue into the non-guarantees, and that is that there are a lot of ripple effects in the pricing of life insurance, and listeners might be wondering, why can't the insurance companies just go into their black box computer program and change 4% to 2% and roll the product out? But there are so many things that they need to look at, probably the most important of which is agent compensation. Agent compensation is going to become a lot more complicated after these changes, and companies are going to have to make some really tough decisions about, are they trying to preserve agent compensation at the level it was before? And who is going to benefit from these changes? Is it going to be entirely absorbed by the consumer, and now they have more efficient policies, and part of that efficiency is due to lower agent compensation? Or are the companies going to claw back some of that advantage in an effort to keep the agent compensation more at a level like it used to be before these rules came into place? And I don't know, but I suspect there's a little bit of a game of chicken going on within the industry right now. I don't know if anybody really wants to be first to market. You said that nobody was out there. That may be true, but I think that there could be some products that are starting to be rolled out, and certainly in some segments of the marketplace, like universal life, for instance, some carriers have products that were simple enough that they could make a quick change and roll those out. But over the next year, there's going to be a lot of confusion. When you're looking at a policy, are you looking at the pre update version? Or are you looking at the post update version? Should you wait? Because these guaranteed cash values are going up, and again, that's probably confusing because people, again, the rates are going down, but the guaranteed cash values themselves are actually going up within the whole life policies. That drives the gross premiums up for carriers, and then, like I said, they have to figure out all these ripple all these ripple effects. And I don't think anybody knows what the end of this story is going to look like. And a year from now, if we do another podcast on this topic, we'll be a lot smarter. We'll see how the industry responded. But that's a good segue into, I don't think people should let perfect be the enemy of good when it comes to jumping into getting a life insurance policy. And these changes are not going to turn an average policy into a great policy. They're probably not even going to turn a good policy into a great policy. You could get a great policy today under the old rules from an accumulation-oriented perspective. And under the new rules, it would just be a little bit greater. It's not going to be a dramatic difference in my view. More importantly, if there are changes, in my view, that incremental value comes in the form of higher non-guaranteed values ultimately. And I think all the gnashing of teeth about are the guarantees going up? Are they going down? I know you and I differ a little bit. I think you place more value on the guarantees within your practice and for your clients. And while I appreciate that there is value there, particularly on a retrospective basis, once you get a dividend and it purchases some paid up additions, there's guaranteed cash value associated with that can't be taken away. And so there is a floor. Your values are not susceptible to dips in the market or anything like that. I just don't think when it comes to differentiating between product A and product B, I don't feel like a different schedule of guarantees in those two products is particularly meaningful in this space. Ultimately what's going to differentiate one cash value policy from another is going to be the non-guaranteed values that are paid over the life of that policy. And when I say non-guaranteed values, the non-guaranteed elements that I'm referring to are the interest, the mortality, the expenses, and maybe to a lesser extent, the lapse rate that affects all of those other components. But it's going to be that actual experience which defines the long-term value. And when it's all said and done, those guarantees aren't going to matter unless you ended up in a guaranteed environment. And life insurance companies, whole life insurance companies, have been operating in a non-guaranteed environment for basically 150 years straight. And even though interest rates have gotten lower and lower and lower, companies are still paying dividends. There's a lot of margin built into the pricing of those policies in the other components. So even though there's not a lot of margin in the interest rate piece, they've got margin in the other pieces. And let's be honest, companies are still crediting a dividend interest rate that's higher than the rate that's embedded in the guaranteed cash values. Even if you had a 4% guaranteed cash value rate, there are companies out there paying a 5% dividend, a 6% dividend. And so there's still a positive contribution to the dividend coming from the interest rate piece. Anyway, that's a long-winded way of saying that I don't think guarantees and how they differ from one policy to another, I don't think that should rank near the top of your considerations when choosing between one policy versus another. The fact that there are guarantees on whole life insurance, I think is meaningful, but I don't know that differentiating one from another carries a lot of weight for me personally anyway.
Yeah, no, I hear you. And I would agree with you as well, because when I look at any life insurance company and a product and someone's interested in cash value, like an item of buyer's remorse that always pops up is someone gets a policy and then they either bought it off the illustration and it didn't perform on par, or it wasn't designed properly and they said, man, I wish I would have known enough from the beginning to have it set up right. And what I've seen to be consistent is, a handful of carriers, four of them, the four major mutuals, have consistently disclosed, hey, here's historical policies. We've got independent studies, comparative studies, and they've delivered. They've delivered strong cash values, strong accumulation, net IRRs, often of over 4% I've seen from those top four carriers. And that's non-guaranteed. It's not based off the guarantees. It's actual data. And I'm big on that because when you look at an illustration, guaranteed, non-guaranteed, like it's an illustration. It's a projection. At the end of the day, who's actually done it? And I've seen those guys do it. And then at the same time, to get into your point, when you look at the guaranteed values, I can take the guaranteed values with one of those companies and compare it to another where they have on paper the same guaranteed rate of 4%, but guaranteed values that are significantly different. Does that mean the one with stronger guarantees is better? Well, when you look at the actual data, what they've done based off their non-guaranteed environment, like no, they go back and forth with each other. Hard to go wrong with either of them. So it's something when you look at the guarantees, but then the actual performance reality, not just what we're able to pull from illustrations and put on paper.
So I mean, there's a great companion point to that. Sometimes people will look at an illustration and they'll look at the dividend amount and they will conclude that the policy that pays higher dividends is superior to the policy that does not. But the dividend piece is just the balancing component in conjunction with the guaranteed cash value to get your policy where it needs to be at the end of the year. So an insurance company will look at, and this is an important point for people to recognize too, at the start of a given policy year, so where you are today, there is no difference between your guaranteed cash value and your non-guaranteed cash value. Your cash value is your cash value. Once your cash value has been credited, like let's say you got a dividend and you purchased a paid up edition, there's a certain amount of cash value that's associated with that. On that day, that is both a guaranteed and a non-guaranteed cash value. And so the guarantees in your policy continue to ratchet up. Every time a dividend is paid on your policy and you turn around and put that dividend into your policy, all of your forward-looking guarantees have been ratcheted up as well. And I think a lot of people are under the misconception that after you've received a bunch of dividends, the insurance company could somehow rip those away and you could go back to your original guaranteed level on your original sales illustration. And that's not the case. And so if your clients want to see this, or if the listeners want to see this, get an in-force illustration on an existing policy, look at the guarantees going forward, and you will see that those guarantees are dramatically higher than when you originally bought the policy, as long as you use the dividends internally, or maybe you had additional premiums that you were putting into the policy, and those additional premiums are purchasing paid up insurance. But the guarantees that were in force on the day you bought the policy almost assuredly are irrelevant now because you've continued to update with additional money that's gone into the policy and your guarantees have ratcheted up.
Yeah, I get it 100%. So call it the original illustration, there were your guaranteed values. Then I've got a policy that's 5, 10 years old, whatever. And then on that in-force illustration, what's my guaranteed values? Call it year 10 compared to what that original illustration compared to year 10. And you'll have more in the in-force because you've received the dividend and such, and that's part of your guarantee moving forward. Did I explain that? That right?
Yeah. And so, I mean, what I was building up to there is how a dividend is calculated. So at the beginning of the year, the insurance company sees the cash value on a policy, and then actual experience is applied. They look at what the mortality charge is that is appropriate for the policy in that state. There's some expenses, there's the actual interest that they're going to credit, and that gets them to an end of year actual cash value. That's what the insurance company thinks that the total cash value should be on that policy at the end of the policy year. Well, then they go back and they say, well, based on where you were at the beginning of the year, what would your guaranteed cash value have been at the end when we take the guaranteed cash value table into account? And the interest rate is a component of that, but there's also a mortality and a built-in expense component as well. And they look and they say, okay, the guaranteed cash value growth would have given you this much increase, and any excess that we identified in the total, the difference between those two is going to be the dividend. So the dividend is simply the balancing mechanism to get the growth in guaranteed cash value all the way up to the growth in the total cash value that the insurance company thought was appropriate. And therefore you can see why it doesn't make any sense to try to isolate the guaranteed cash value piece, and it doesn't make any sense to try to isolate the dividend piece. It's the combination of those two that determine the total growth in value on a policy over the course of a policy year. And the only time that that guaranteed value becomes relevant is if, when you compare the guaranteed cash value at the end of the year to the total cash value, if the total cash value is below the guaranteed cash value, the company isn't going to pay a negative dividend. They can't go below zero. And so then you would be in the proverbial zero dividend environment, and your end of year cash value would solely be determined by the guaranteed cash value scale. That almost never happens. It can happen in the early years of a policy, but like I said, for 150 plus years, mutual companies collectively have been operating in a non-zero dividend environment. So there's just so many complexities behind the scenes, and I don't want to toot our own horn here, but there's a lot of smart people making bad decisions with respect to life insurance because they know just enough to be dangerous, and they compare a bunch of illustrations and they'll isolate on, like I said, they'll fixate on the dividend piece, or they'll fixate on just the guaranteed cash value piece, and it's so much more complicated than that. So no matter how smart you are or how wealthy you are, it's good to have a second opinion, and it's good to have somebody in your corner that isn't trying to sell you something.
Yeah, I fully agree with that. And I mean, I've seen so much of that. I've heard it from consumers that will sometimes shop if they're isolating the dividend and such. I hear it all the time because a lot of companies life insurance carriers will pay a higher dividend, a surplus, if you have a higher base premium over the life of that policy. You'll see, okay, look at this great dividend on paper. But at the end of the day, when you look at the actual net cash value, both illustrated and historical, like I don't care, because the total cash value is not greater. Like if the dividend's significantly lesser on paper, but I've got more net value, that's what's important to me as a consumer. So, isolating different areas, it's good to have some awareness. I mean, I won't go into that because I'll keep going, but it's good to have awareness on that. But at the end of the day, like, what gives you greater net value based off of what we see today, the present environment? If you want to look at a conservative dividend or guarantees, hey, that's great. But also real data, historical performance. Like, I like looking at all of that to see, okay, what's going to give you the greatest net value? That way you have maximum value, maximum flexibility if anything happens, and you can use it, whatever your goals are. Retirement, if you want to, if you like the idea of borrowing from it, whatever it might be, optimize everything first, and that way you've got the most operating capital to work with for whatever it is.
Yeah, no, I agree. And another thing just to consider is that with the complexity here, insurance companies are trying to sell policies. Life insurance agents are trying to sell policies. When things get this complicated, they can be manipulated in how they're presented. And so it's possible, and they don't even necessarily need to be unscrupulous. They might just be not as educated. There could be agents that are misleading clients and leading them down the wrong path. And it could be self-serving, or it could simply be that they're not aware. And frankly, it really doesn't matter to me. My interest is making sure that my clients get the best foot put forward on their behalf. But it's definitely a situation in life insurance that I think it needs to be buyer beware. Because of the complexity that's there, you're often put into a situation where you're buying insurance on the basis of trust. And because of that, there is lots of opportunity for suboptimal decision making, let's just say.
Yeah, no, you're 100% right. And I mean, we see it all the time. One thing I've seen recently is, hey, IULs will be much, much more superior to whole life now because that guaranteed rate that made whole life so strong is coming down. And we already touched on this, like, okay, that's not the reality of it. So that, I don't think agents ever maliciously do that. They just don't have the information right now. They just see it, say, hey, IUL has a lower guaranteed rate, 0 or whatever it is. Now whole life's coming down. Woohoo! But at the end of the day, like IUL and whole life have a purpose. I'm not attacking one or the other. It's more so just transparency. It's like, okay, you've got to know how it works. And if you're worried about, hey, I don't want to talk to an agent that's just going to say go one way or the other, like that's really where your company comes into play, because you're not going to sell one or the other. It's like, here it is, here's how it works, and here's what to look for.
Yeah, I'm glad you brought that up because I want to tackle that head on. Let's ignore the crediting strategies and the indexing on the IUL policy, but let's just focus on IUL versus whole life. One of the biggest advantages that UL had over whole life was that it could use the guideline premium test, and you could stuff more money into an accumulation oriented policy if you jump through the right hoops and use the right death benefit option and various things. But much of that advantage has been eroded now with these changes. And so the guideline premium test no longer enjoys the same type of advantage over the cash value accumulation test. And by extension, then IUL sometimes looked better than whole life simply because you could more efficiently stuff money into the UL chassis. And there was a built-in advantage for IUL or any type of UL, frankly, whether it's VUL or just a regular old UL policy. There was an advantage to UL because of its ability to use the guideline premium test, while whole life insurance had to use the cash value accumulation test. Now with the law updates, there is less distinction between those two in terms of how they practically impact the design of a policy. And again, a year from now, we're going to be a lot smarter, but I don't know if the UL guideline premium chassis, it may have had its heyday. I'm not saying it's not going to exist going forward, but it's a less compelling story than it used to be. Now, there are people that will convince themselves that there's other reasons to buy IUL, and I think you and I have touched on that, and that's a topic for another day. But from a structural advantage standpoint, the UL chassis no longer enjoys the magnitude of the advantage that it did over whole life when it comes to certain types of accumulation designs.
Yeah. And that's such an interesting point, just because when you look at it on the surface, more so as an agent, going back to the gross rate, you think, okay, it evens the playing field out, making one think, okay, now IUL has a better advantage on the guarantees. But in the reality, it's like, no, it actually evens it out on the non-guaranteed side. A whole life, it becomes stronger in that respect. And again, like you said, a year from now, we'll see the difference. But I go back to that example that I've actually seen with a BOLI product. It's like, hey, lower guaranteed rate, stronger net value, and the compensation on that actually stayed exactly the same. So we'll see how it works. I've heard a lot of stuff as well with the retail products, but with BOLI, it did stay the same with that company and that product.
Well, I'm gonna kind of close with a self-serving promotion here, and probably if there are any agents listening, might make them mad. But the explanation of guaranteed cash values and how dividends work has been wrong. The vast majority of times I've heard somebody attempt to explain it, it's been wrong. And I guess my cautionary word to the listeners is, why would you trust somebody to explain what the changes mean to you when they couldn't properly explain how things worked before? And so, there's the danger here of the blind leading the blind a little bit when it comes to rushing into a sale or even being advised to wait for a sale. There's a lot of agents that are really smart people and really good people, but they're just not trained to understand how guaranteed cash values work, what the implications are of 7702 and the updates. And I don't know how you tell the difference between how does my agent really know or not. And I think you need to go to somebody unbiased, and it doesn't have to be me, but there are other people in the country that are fee-only insurance advisors. And I just think if you've got a lot of money at stake and there's a lot of confusion, I think you are well served to get advice from somebody that can serve in a true fiduciary capacity and whose compensation does not depend on what your decisions are. And to reiterate, I'm going to get paid on an hourly or a project fee no matter what you decide to do. If a client hires me, I don't get paid extra if they buy a policy or if they buy a certain type of policy. There's no kickback arrangement. I know sometimes I have clients that buy policies from you. You and I have no relationship other than doing these podcasts together. And so it makes no difference to me financially if my clients buy a policy from you or from any other agent that's out there. I like it's a good deal for my clients to go to you because I know it takes less of my time. You know the drill, you know how to put the best foot forward for my clients, and I don't have to spend as much time looking over your shoulder, making sure that you're not trying to squeeze out some extra compensation or pleading ignorance on something. So it's a good deal for clients that hire me for them to utilize your services just because it's streamlined and it keeps my bill down and they know they're getting the best deal possible from you. So anyway, that's the end of my promotional piece there.
No, I hear you, and I appreciate it as well. Yeah, I mean, that's what it's about. How do you maximize the value, make sure it fits into your goals? Today, we were laser focused on life insurance, the product, what it is now, what's going to happen, guaranteed, non-guaranteed, or at least our foresight with a little bit of data that we have because we are fortunate to have that BOLI product. And I guess to sum it up with what you said, where it's like, hey, trying to make sure we get the right advice. Like my thing is, I love the idea of having someone that's non-biased, independent, looking out for my best interest. I actually just connected with an attorney. She works with ultra high net worth individuals through a client that we're working with, but she was so sharp and she actually knew about life insurance in and out. Like if you're an agent trying to smooth talk her to say, hey, here's how you should design a policy for greater long-term value, she'll knock you out. I'm like, I like this person. I hired her. But the independent advice is always valuable. But at the same time, like I've always looked at it, and this is how I started when I first went on my own, is seeing what the ultra wealthy do. Corporations, banks, when I had the privilege of designing policies for those individuals, those corporations, it's like, okay, that works. It's worked for a long time, still working very well. Why not just copy them to the greatest degree possible? And the objections I get sometimes is, well, it's less comp to you. I'm like, well, I don't care because if you're doing the right thing, the business will stay on the books and you'll make more over time. Like it's not about the money. Just do what's right for them and everything will come. At least that's how my parents raised me.
Yeah, and I know agents face a moral dilemma. They want to earn enough money so that they're around to service the business and to make sure that their business is viable. But when somebody like you gets to a certain level, you have the luxury of being able to take the moral high ground and still put food on the table. And so, that's what I really appreciate is you've got a scale that allows you to just, say you're always going to put the client's best foot forward and you don't have to compromise and try to rationalize, why a higher commission policy makes sense.
Mm-hmm. Yeah, no, I'm with you. And when I started the business, I lived at home as I built everything up. So that's how I did it.
Well, commission's that low. I mean,
yeah.
You've got to have volume to stay in business for sure.
It took some time, but once it gets going, it's the snowball effect. But anyway, this has been great. Really appreciate your time today. Good topic. If anyone has questions or would like to talk to Scott or our company, links below on the YouTube link or in the podcast link. Feel free to reach out anytime. You can call, email us, and we're always happy to talk.
All right.
Thanks so much, Scott. Really appreciate your time. Yeah,
thank you. Day.
You too. Thanks. Mm-hmm. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.